Every organization measures financial risk. Revenue forecasts. Cash flow. Market exposure. Operational costs. Boards expect these risks to be quantified, monitored, and discussed using a common business language. Cyber risk should be no different. Yet many organizations still measure cybersecurity using technical metrics that provide little insight into business impact. In this briefing, we'll examine why cyber risk should be measured like financial risk and how executive leaders can make better decisions by changing the conversation. Most cybersecurity dashboards focus on operational activity. They report the number of detected attacks, open vulnerabilities, patched systems, completed awareness training, or compliance status. These metrics are useful for managing security operations. But they rarely answer the questions that matter most to executive leadership. What is our largest cyber exposure? How could that exposure affect the business? Which risks deserve investment today? And how much uncertainty are we willing to accept? Without answers to these questions, cybersecurity becomes difficult to prioritize alongside other business risks. The consequence is that security investments are often driven by fear, compliance deadlines, or the latest headline rather than objective risk. One business unit requests additional funding. Another requests modernization. Security requests new technology. Leadership must decide where limited resources will create the greatest value. That decision becomes much easier when cyber risk is expressed in business terms instead of technical language. Mature organizations increasingly evaluate cyber risk using the same principles applied to financial and operational risk. They consider likelihood, potential business impact, recovery costs, operational disruption, regulatory exposure, customer trust, and long-term strategic consequences. This allows executives to compare cybersecurity investments with other enterprise priorities using a common framework. Cybersecurity is no longer competing for attention based on technical urgency. It is competing based on business value. This also changes how success is measured. The objective is not to eliminate every cyber risk. That would be impossible. Just as financial risk cannot be eliminated, cyber risk must be understood, prioritized, and managed within acceptable levels. Boards should ask whether the organization's largest cyber risks are clearly identified, whether investments are reducing meaningful exposure, and whether risk is decreasing over time. These are governance questions, not technical questions. High-performing organizations also recognize that cyber risk changes continuously. New technologies, acquisitions, cloud adoption, artificial intelligence, third-party dependencies, and changing threat landscapes all influence the organization's overall risk profile. Effective governance requires regular reassessment rather than static reporting. The organizations that manage cyber risk successfully are not the ones collecting the most security metrics. They are the ones translating cyber risk into business decisions. Because executives allocate resources based on business priorities. And cybersecurity creates the greatest value when it speaks the language of business. Subscribe to Cyber Risk Review for weekly executive cybersecurity intelligence briefings focused on governance, resilience, AI risk, technical due diligence, and enterprise cyber strategy.